You are listening to the CMQ Investing Podcast. My name is Chris Franco. What you were about to listen to is actually a response that I did to a question I received on Instagram Live via the Charlie Munger Quotes account, which, by the way, we're almost at 100,000 followers. So thank you to everyone who follows that. It's been a passion project that's evolved into so much more. So thanks again. My response was initially a video, but for whatever reason, there were some technical difficulties. And basically, I won't even bore you with the details, but the visuals were all off. The audio, however, is full of value. It's short, it's condensed, it's edited a little bit more how I like to edit things for YouTube. You know, I don't actually just do the same thing on YouTube as I do in the podcast. It's a unique format of content. So you might notice a little bit of a difference, but there's too much value here to not share with you. So it's short, it's sweet. I know sometimes people appreciate that. They like the little, kind of like the mini nuggets of gold type episodes. Again, this is just my opinion, but I think the argument is strong. Hopefully you enjoy it. And thanks so much for listening. Before you get to it, though, if you haven't already, please follow the podcast on whatever podcast service you're using. It only takes a moment, and that way you will be first to receive all the latest updates in your feed, and they are coming at a rapid pace, so you don't want to miss out on that. I appreciate everyone for listening. Let's get into it. I received a number of requests to give my thoughts on emerging market ETFs. I'm looking to give you my honest, straightforward opinion based on my research, based on the lessons of legendary investors. In my view, emerging market ETFs are a ripoff for retail investors like us. They are a product that was made to be sold for a profit, and that profit takes away from our returns. So let's get into my three objections, starting with costs. Jack Bogle has taught me a number of invaluable lessons about investing, but probably his most important lesson is about the importance of the role of costs. Costs are a killer for individual investors that have a long time horizon. And emerging market ETFs typically have very high expense ratios, at least relative to any of the index ETFs that I invest in, like the VU, which has a 0.03 expense ratio. One of the very first results that came up when I typed in emerging market ETF on Google has a gross expense ratio of 1.63%. I mean, 1.63% is crippling. Here's a great quote from Jack Bogle about this. The fund industry, its unremitting aim is to build enormous assets through opportunistic marketing and new product adventurism, all lumped on top of costs that cannot possibly be recouped by superior performance. In a brutish world peppered by smart, educated, experienced, and professional money managers who are competing with one another, managers as a group are inevitably consigned to average returns before costs. And after costs are deducted, they are destined to be losers. The arithmetic is unarguable. What more is there to say? Next is just the concept. It's a concept that violates the first principles of investing because it looks at investing through this lens of markets or countries, not businesses. In 2013, at the Berkshire Hathaway annual shareholder meeting, Warren Buffett answered a question about emerging markets, not specifically emerging market ETFs, but his reply here is very relevant to this discussion. When we hear somebody talking concepts or any sort, including country by country concepts or whatever it might be, we tend to think that they're probably going to do better at selling than at investing. Warren Buffett goes on to say that the thing to do is just find a good business at an attractive price and buy it. Finally, complexity. In my view, an emerging market ETF just adds complexity where I really don't need any. The best investment strategy for both individual investors and frankly, a lot of the legends that I like to talk about, simplicity is the name of the game. Doesn't mean it's easy, but it should be simple. The more complexity you add, the more ways things can go wrong, the higher the probability there is for error. That's just the reality. It's unnecessary. There would be some that argue and say, well, with a emerging market ETF, you get to diversify internationally. But my preferred ETF, the VU, which gives me exposure to the 500 largest companies in the US, that gives me plenty of diversification. And many of those companies, I don't know the exact number, but probably most of them, do business internationally. So aren't I getting some international exposure that way as well? Just something to think about. Before we go any further, I just want to remind you that there are nearly 100 additional episodes of this podcast you can listen to for free. So make sure you scroll through the feed, check out what we have to offer. There's lots of value there for you that I hope you're able to put to use, make the most of, and just enjoy. Beyond that, don't forget, if you haven't already, it helps so much if you could leave a 5-star rating and write a written review if you're listening on Apple. And last but not least, don't forget about the YouTube channel. This content that you just listened to was initially made for YouTube, so don't forget to check that out. It's CMQ Investing, just like the podcast. CMQ Investing on Apple and Spotify, CMQ Investing on YouTube. You know the deal. Thanks so much for listening. Look forward to talking to you soon. Have a great rest of the day, the night, whatever the time is. You know what time it is. CMQ, rational time. Later.